evolution of repurchase obligation. This is kind of just a graphic showing how an ESOP's overall balance sheet looks as it goes from initial implementation through the what I would call very mature ESOP cycle in D, where you have more issues. But essentially what you can see is post-transaction, you're really balancing debt service with free cash flow and the ability to pay off debt from any senior lending that you did to facilitate the transaction, and then later on seller notes and warrants. You've got some ability to invest, but that's somewhat hindered in the early stages, at least until you pay off the senior level debt, at which point you'll have more free cash flow to potentially invest in the business and grow it more effectively. The mid ESOP cycle is where basically you have that senior level debt. Maybe you refinance some of the seller debt, maybe you don't, but you have a little bit lower level of debt service requirement. As things really mature, you're going to really have the debt service for normal operations after the transaction debt is repaid. But then you have to feather in this repurchase obligation, which we're going to talk about here in a moment, because that's going to be, depending on how you plan for it, and there are a bunch of different funding options, which we'll touch on at a very high level, but there needs to be on an annual basis for most companies some sort of a payout to former participants who are eligible to receive funds. That can impede to a degree on your ability to invest or not, depending on how well the company is growing. Nick, I know you have some additional insights you'd like to share here.
Yeah, there's a couple things I think that are really important to think about when we're looking at this evolution of the repurchase obligation and an ESOP life cycle. One is we don't have time listed on this slide. You'll often hear people use different time periods as proxies for moving through these life cycles. But the real answer with that is it depends. If you have really high growth, you can move to the mid cycle really quickly. If you end up with an ESOP structure where there's a meaningful redemption of shares, say for a second stage transaction, you could potentially move to the mature side of things in a relatively short period of time. What's more important to think about is how your balance sheet is changing. How is the debt service need changing? What am I accumulating as an RO obligation to help better define where you are in the life cycle, including what's my share allocation? How many shares in the ESOP have I allocated? And that can help better define where you are for moving through this life cycle. The second thing that I would really encourage you to think about is typically that midlife ESOP is something that only is going to occur once, and it's a true sweet spot when it comes to cash flow generation, and that I've paid down a lot of my transaction debt, but oftentimes I haven't had meaningful RO come in as an obligation yet to cash flow. And I'm also not paying taxes in this time. One of the things that I really encourage companies to look at is make sure that that unfunded liability that you're accumulating as the ESOP is allocating shares and people are vesting is recognized during this period, or you can get a really misleading picture of what your long-term cash flow generation and yield is. And that's where when we talk about that RO being a forward-looking obligation to understand the magnitude of it, when you're in that midlife ESOP, it's one of the periods that you have the most flexibility to make strategic, financial, and plan and policy design changes. Once you get out into C, and especially when we get to the truly a mature ESOP or one that's gotten unbalanced, where the RO is creating other operational and strategic issues, your options get more constrained. So just a few things worth thinking about as you're looking at where your company is in this life cycle and how you're progressing through it.
Thanks, Nick. The last thing I want to add here is that when we say throughout this presentation, when we're talking about debt service or debt, we're speaking to company debt, not the ESOP note. There tends to be in newer ESOPs some confusion as to whether or not the ESOP note is company debt. It is not. It's an obligation of the trust and is cash flow neutral to the company for the payments. So that would be something that we're not talking about here.
And Alex, I would ask, just is there anything here that you think really stands out that companies underestimate about RO, timing, magnitude, variability, or how they can better understand and not be surprised by moving between stages? What are signs that can help them recognize that?
Well, the key thing here is to have frequent conversations with your third-party administrator. And so what happens in a lot of cases when a new ESOP is implemented, there is plan document language that allows for a lot of flexibility. When you read your plan documents, most cases they use may language, meaning you may do this or that, versus shall language, which is very definitive. And so the biggest issue that most companies get caught up in is delaying distributions, and then they have big repurchase obligations come from delayed distributions when it's inconvenient. In a lot of cases, when you're looking at your plan document, you don't have to do that delay. So if you're talking to your third-party administrator and you understand the demographics of your participant base, you can understand exactly how to implement the distribution policy within the plan so that it doesn't catch you in some sort of bubble, if you will.
I think that's a fantastic point just before we move on, in that if you're making those decisions in B or C, you're really influencing, especially if you're making them in A for forming the ESOP or in B when you're in midlife, you're really influencing and creating the situation that you're going to find yourself in when you get into C or potentially D. And so
Yep.
that's what really making sure that you understand when you're having those conversations about not just the consequence of a decision today, but how that will influence where you find yourself 5 years in the future is very important.
Absolutely.